Deflation is basically a period of sustained falls in price levels. When it occurs, on the one hand, you could say, well, that's nice. We like when prices go down at the supermarket and prices for cars and so on. That's all very good. The problem is what you call bad deflation. That is when prices are going down, but not just that, your wages are going down and the assets you invest in are going down. And we saw bouts of bad deflation in the 1930s and also more recently in Japan. And that can be very debilitating for economies because investors invest less and, of course, people delay spending. Lately, we've seen a lot more talk about deflation. Obviously, the fears of inflation that were around a few years ago in response to monetary easing globally seem to have faded, and we've seen inflation rates right around the world continue to fall. And there's several reasons or factors driving all of this. The first one, of course, is the fall in commodity prices, more recently the collapse in oil prices, and that, of course, has driven some countries' inflation rates, notably Europe, for example, into negative territory. In other words, they've got deflation. Behind all of that, though, and this is the real concern, is that you've got a lot of spare capacity. We've had a sort of an economic recovery from the GFC, but it hasn't fully used up that spare capacity. You've still got unemployed labour resources and unemployed factories around the world, and that's leading to a very competitive environment and ongoing downwards pressure on prices. How likely is a sustained period of deflation? I would say it's certainly a risk, certainly something worth keeping an eye on, and we've seen bond yields fall in response to those risks. At the end of the day, though, I think other central banks will do what the US have done, and that is pump more cash into their economies to try and head it off. The US is probably least at risk because they've done that. We're now seeing Japan pump a lot of cash into its economy, and I think we're going to see Europe do exactly the same thing going forward. So all of those things should start to gradually head off the risk of a sustained bout of deflation. If we get a severe bout of deflation lasting several years, then that would be bad news for growth assets. The growth wouldn't be there, and historically you've found that it's bad news for share markets, as we saw in the Japanese share market over the last 20 years or so. The more likely scenario is an ongoing period of low inflation, and that deflation ultimately will be headed off, or that risk will be avoided. That still means an ongoing period of very low interest rates. You're going to see central banks around the world keeping interest rates at pretty low levels. It also means pretty low returns from government bonds, as yields there are already quite low, in fact at record lows in some areas. And for shares, it probably is a bit mixed, but overall I think it's more of a positive than a negative because it delays the time when central banks have to start raising interest rates, and investors looking for decent returns will turn to growth assets. So overall, the environment we're in, providing severe deflation is avoided, is not a bad one for growth assets.